So one of the things that people find sometimes awkward about financial accounting is simply the debit and credit rules. So let's take a minute and review the basic accounting equation. Assets equal liabilities plus stockholders' equity. Now, stockholders' equity assumes that this is a corporation, but obviously businesses could be organized as limited liability companies, partnerships, sole proprietorships. So a lot of times, even though your textbook probably says assets equal liabilities plus stockholders' equity, I like to express it as assets equal liabilities plus owner's equity. That's simply a more generic term for stockholders' equity, members' equity for an LLC, partners' capital for a partnership. So it's a broader term. Plus, it lets me do this. Now think about this. Every business, I don't care how big the business is or how small the business is. It could be as big as Facebook or General Electric or Under Armour, or it could be as small as your local plumbing and heating company, is going to have accounts that fall into one of these 5 major categories: assets, liabilities, owner's equity, revenues, and then expenses. Obviously, Under Armour is going to have a lot more expenses and asset accounts and revenue accounts than your local business, but still, we're going to have the same 5 basic building blocks. And what we can do here, let's put DR and CR. Now, what that really stands for is debit record and credit record. Now, debit doesn't mean plus or minus. It doesn't mean increase or decrease, and nor does credit. Debit record simply means an entry on the left-hand side of an account. Credit record means an entry on the right-hand side of the account. So we have these bookkeeping rules. If you want an asset account to increase, what you need to do is make a debit entry to that particular account. So cash is probably the most familiar asset for a lot of people. If you want the cash account to get bigger, to increase, simply make a debit entry to that account. Now, obviously, if you want the cash account to become smaller, to go down, you're going to make a credit entry to that same account. Okay? Now, the thing you can do next is you can remember that expenses have the same behavior as assets. So if you want an expense account to become larger, debit it. If you want an expense account to become smaller, make a credit entry to it. Once we've done this, we're really well on the way to having the building blocks for the other 3 parts. Because if you can memorize or understand that an asset goes up with a debit and that expenses behave the same way, then you will know the rules for liabilities, owner's equity, and revenue, because those behave exactly the opposite. If you want a liability to go up, you actually make a credit entry to their liability. And let's think about why that might be the case. If you take a look at this accounting equation once again, okay, the assets are on the other side of the equal sign from the liabilities. So it makes sense that if we were to make an asset increase with a debit, since this liability is on the other side of the equation, it's going to have an opposite effect if we make a debit entry to that account. So anything that's on the other side of the equal sign is going to behave opposite of what an asset does. So that's the basic building blocks for the debit and credit rules, the bookkeeping rules. I think that this chart that we have right here is a wonderful tool if you start to get confused as you're making journal entries and you're not sure if you should debit an account or if you should credit the account. If you can commit this chart to memory and be able to recreate it, it will give you a tool that you can use as a reference for the debit and credit rules.